live very shortly. There we go. Hi, folks. Welcome to our live panel discussion today. My name's Rachel Whitehead. I'm VP Marketing here at ChartMogul, and I'm going to be our moderator for today's discussion. Joining me is this panel, full of experience around B2B SaaS and investment. And so obviously today, our topic of discussion is around how to fundraise in a bear market, or at least in challenging, economic situations. So we're super lucky to be joined by Ingrid, Christoph, and Danil today. And maybe to start off with intros, Ingrid, can you introduce yourself?
Sure. Hi, everybody. Really great to be here. And thanks to Rachel and Catherine for inviting me. Name is Ingrid Bonde Äkerlind. I'm an investor at Ox VC. We're a B2B SaaS specialist fund investing at the early emerging go-to-market fit phase when acquisition, retention, upsell, all of that good stuff is starting to become predictable. Based in Stockholm and the UK, investing across Europe. Don't care too much about letter names, but basically this translates to Series A and Series B. And my own background pre-investing comes as a go-to-market side operator in European tech startups.
Awesome. Thank you, Ingrid. I love you've been on both sides of the table for sure. Okay, let's move along. Danil, what about you?
Thank you. Thank you for inviting me, Rachel and Catherine, and super excited to be part of this honored panel. Well, I'm the founder of Go Global World. It's a platform where we connect startups and investors with the power of AI and helping connecting relevant investors to relevant startups. I'm also an angel investor. I'm on the founder side, on the investor side, and we work a lot with early stage companies, a little bit with later stage, and we have a quite large network of founders and investors that are working together.
Awesome. Thanks, Danil. And also special shout out because we're obviously recording this live. Danil's over in the Bay Area, so it's very early in the morning for him. So thanks again. We won't judge you if you need to go get some coffee or something halfway through. But all right. Perfect. And wrapping up the panel, we have Christoph. Welcome, Christoph.
Hi, thanks, Rachel, and thanks to the ChartMogul team for setting this up and for inviting us and me. I'm Christoph Janz. I'm an early stage investor. I'm a founding partner at Point 9 Capital. I've been investing in SaaS companies for about 15 years. I'm starting as an angel investor in 2008, and then from around 2011 on with Point 9. And one of the companies that we're a very happy investor in is ChartMogul.
Yeah. All the lines connect together there. Cool. Well, again, thank you to our panelists for coming along today. For those of you in the audience, just to orientate you, in the bottom right of your screen, you'll see a couple of different tabs. There's a place to chat. And Catherine there from ChartMogul will be moderating. You can also post your own questions that pop up as we go through the discussion today. And there'll also be a couple of polls going live as well, so that we can find out a little bit more about what folks are thinking as we go through. In the meantime, though, I have a long list of questions. And actually, before we started today, we were having a discussion about how we have too many questions to ask. So I got to use time better. So let's jump straight into it. We talk about this term, a bear market, and I guess the first question for the panel here is, what's uniquely different about the current sort of fundraising environment that's different from, say, pre-pandemic or 2021? What sort of changed? And perhaps understanding a little bit about how has the area where you focus on, whether that be early stage or angel stage or later stage, how has that changed compared to what it was a couple of years ago? Who wants to kick us off?
Well, I can start. Well, we gotta face the reality. Investors are investing less, right? We can see that, and the market environment is not in favor for investors and startups, and investors are expecting some founders to actually drop their valuations just because of market is changing. So the competition among startups is increasing, and for the capital. And we also gotta keep in mind that the money is still there. The dry powder is high, it's so high, and investors are looking at a wiser way of actually cherry picking the best companies, considering the changing environment. And the AI came into play, making founders more efficient, and so they gotta actually act on this to change something in their existing technology, or not to miss on the opportunity, or maybe use this to leverage the efficiency for their companies. So the entire landscape significantly has changed, so the founders and investors gotta change. The technology advancement is giving the opportunity to actually better find and faster find the right founders, but also it's a rising threat as well. So founders need to address that. I'm not gonna take the entire stage. I'm sure my peers have a lot to say about that, so I'll let them to actually have the word too.
Yeah, great point, Ingrid. I mean, it sounds.
I mean, yeah.
Go ahead.
I was going to say that for sure, like, valuations have changed, but so has company performance, right? Companies, when you see the metrics of companies that are staged, they're not what they used to be in 2021, and so you look at them differently. But I think there's one thing you said, Danil, too, which is true, which is, yes, pricing has changed, but what's the hardest thing too for, like, if you're a founder going out to fundraise now, you still have a price anchor. Like, we don't forget about the pricing that we used to have. We sort of remember it. And it's leading to a lot of uncertainty and rounds taking longer to close on the market because expectations aren't necessarily aligned, but B, even more, we just don't have as much data. We're sort of figuring out our way in this new normal, so to speak.
Yeah. A great point, Christoph. How has it changed for sort of the early stage, seed stage?
Yeah, I mean, it's a really interesting time, right? It seems like we are coming out of a bear market now, or at least, like, if you look at public tech stocks, they are actually pretty high again, maybe not as high as they were at the peak of the bubble, but seems like at least the public markets are already recovering, and that usually trickles down to private markets. And this basically followed a pretty large bubble that got bigger and bigger around 2018, 2019, leading up to 2021. And then on top of this, obviously, you have really big like macro and geopolitical issues, to say the least, to put it mildly. And then you have AI, which is an incredibly exciting and mostly positive development. So I think it's hard to navigate with all these different factors that they're sometimes also like really have opposite to each other. If I look back at how we've been investing at Point9 in the last few years, 2022 has been a slower year for us. I think it's been like this for most investors, because founders, given all the uncertainty that was there in 2022, if they didn't have to raise, they just waited, right? So it means that we saw fewer companies, and we were also quite busy helping our portfolio companies navigate through this change in financing environment, like trying to increase runway, like looking at profitability or efficiency, like trying to find a way to finance a company who might not be able yet, or might not be in the position to go out for the next round. And then last year, things started to pick up again. And I feel like now everybody is more or less trying to find what's the new normal, because to your point, Ingrid, the 2021 was not normal, and this is not going to come back anytime soon in terms of valuations and multiples. So I think nobody should kind of wait until those multiples will come back, because I don't think they will come back within the next couple of years at the minimum.
Yeah.
The fun fact, I would add that actually the amount of startups, it feels like it's going to increase exponentially because with AI, the access to the market and prototyping, all of this is just changing and helping them to make it so fast and so cheap. So more startups will be raising and more startups will be spamming investors. It's also another fact.
But I mean, we're seeing it also start to pick up at the later stages too, that the activity this Q1 2024 is definitely higher than it was, say, 12 months ago at our stages. And the startups coming have a much higher probability of sort of completing their funding rounds. This is sort of way I often think about it when I first meet them. So what I hope for is that we can look back at 2024 and we say, this is the new normal. And it was a really boring year because everything happened the way it should.
I think that's what we're all hoping for. Our last few years, that sound attractive for once. You know, a couple of you mentioned AI, and particularly when we reflect on investments last year, it was very clear that where there was, you know, really solid investment activity, a lot of it, you know, even the majority of it was with generative AI companies. And so definitely, I know, you know, a lot of buzz from speaking with founders out there in the community is, okay, if I have an existing SaaS company, how important is it for me to start thinking about my AI play when it comes to raising an investment? You know, is that a hack? Is that a must-have? What do you all think about that today? And I'm not talking about necessarily sort of native generative AI companies, but existing companies who are you know, at whatever scale and stage that they're at. How important is it to you all having an answer to what's their AI play, or how are they thinking about adopting this technology?
I'm happy to start. I mean, there is a lot to unpack, but I think founders should think about it, but not primarily because it's what investors expect. I mean, investors will definitely ask these questions, but that shouldn't be the main reason why, if you are a founder or a CEO of a B2B SaaS company in 2024, you should be thinking about AI. And I think the reason why you should is that it's hard to imagine for me to find a software product where you find no angle for improving it with these new capabilities. And maybe it's not obvious, and maybe you have to like try a few things, and maybe the first ideas don't work, or like the users just don't want it. So there is some exploration to be done. But if you just think about like what software does, it enables some kind of workflow, and like there's some like data coming in, data coming out, and connecting people doing various things. I think if you think about it deeply, you'll usually find ways to automate parts of these workflows using AI. So it's not like we have become a 100% AI investor, but at the same time, if we meet a company, I would be surprised if they haven't thought about it, like also just out of intellectual curiosity, right? If you're in tech and product and software development, this is just too exciting to ignore.
And if you take the perspective too, that like you should be thinking about it, is that you should be knowing what your competitors are doing, what the incumbents are doing, and they've probably been putting AI onto their roadmaps. And so part of your job as a founder is to know where the market in your particular vertical is going. And then sure, you can, like, I guess from my perspective, if you make an explicit decision to say, actually, I do not think generative AI is going to disrupt my sector, cool. If you can defend that, like, I'm willing to listen. But the market is likely going to have thought about it. So therefore, you should have thought about what your market thinks about this direction of AI.
Yeah.
Again, the investors will ask, but that's not the reason. I agree with you there, Christoph. It's not the reason to have thought about it in the first place.
Yeah, I agree with that. AI for the sake of AI doesn't make sense, and building another AI for like in-house that's already built doesn't make any sense as well. But the question is like, can the existing solutions reduce my operating costs as a founder? Can I bring extra value with some automations for my customers? Can I delight my customers with these extra features, extra things that would cost me, say, nothing or very little, and they would be even more happy with our solution and stay with the company longer, and retention will grow. So many founders are using right now, as part of my research, are using this for their internal process automation and simplifying things for themselves. Even like writing an email is already helping you with ChatGPT or some other solutions, and sometimes it's even better than you can do it yourself. And this is also helping on the customer side as well. So look at this like as an opportunity to reduce your costs and make yourself more efficient, and try to stay away from this buzz of just AI for the sake of AI.
That's a really good point. Oh, sorry, Ingrid.
No, I was going to say, I think it's interesting what you point out, Danil, because sort of one can assume that in that question we're going to, what are you doing for your product roadmap? What are you doing for your internal operations? I haven't yet seen many companies come and pitch me and actually explain, like, look, the percentage of my OpEx that is going towards like non-personnel is lower because I'm using AI. It'll be really interesting to see if that actually develops as a theme in 2024, if people are starting to measure that more and to show how they can grow more capitally efficiently because of it. There have been a few papers that have been put out sort of laying out the theoretical case, but it hasn't yet translated to the investment case yet. So it'll be interesting. Like, that's something I'm waiting for to see if companies are able to implement it and measure it, and therefore argue that they're a better case to invest in.
Yes, it's a great thought. Not just what's our internal AI play, as you said, to improve the product, but also how is it helping us drive efficiency? And I know that efficiency and AI were probably like the two themes of 2023, maybe even 2022. And to be frank, probably a little bit of 2024, if not completely once again. And so, marrying those two concepts together is really interesting. On the topic of efficiency, last year, I think myself and many founders, this is the sort of stuff that we were hearing, that it's all about showing and proving your efficiency. This is what, investors really want to see out there today. So what does that look like now when you're looking at, different organizations, different companies out there? What are the sort of indicators that seem to matter most to you today? Is it efficiency, or are there other pieces like the team, the product, the industry, the go-to-market that are more important than they were in the past?
Yeah, I can start. First of all, investors are looking at the basics anyway. The world hasn't changed that much, so the basics wouldn't go away. Like, they want to see the team. They want to see how it actually executes. What it makes something then qualify to solve the problem they're solving, and what is the experience, the background they have, where they are, what they know about the customers, what others don't, and what it compares to the competition, and of course the size of the market. But I didn't say anything that is wouldn't be. Everyone knows most of this. I would say there is competition among founders right now for investors' money, and investors right now want to see how you stand out, but how you, not just you have the idea, but what is your traction. And it's hard, but they want to see how fast you act, how fast you achieve stuff. And so when they put some dollar into you, they want to see this return sooner. So they want to see this action acting and the results happening.
Christoph, what about you?
Yeah. So efficiency and like unit economic profitability and so on has become a lot more important, and we can talk about that. But I think it's worth pointing out, nevertheless, that investors are still looking for growth, right? At the seed stage where we invest, sometimes it's even pre-product, or there aren't significant metrics yet. But by the time founders raise a Series A or a Series B, the first thing that investors will ask for or look at is still growth, like some kind of momentum, because VC investors want to find companies that can become very, very large over the course of, let's say, 10 years or so. So you have to grow very, very fast to have a chance at this. And then if they are excited about the company based on the idea and the team and usually the growth, then they will dig in deeper, and then they will probably ask questions around efficiency and customer acquisition costs and payback and all these things. And I think during the peak days of the bubble, investors probably forgot to ask these questions, or at least they didn't prioritize them, and maybe because money was so cheap. But the cost of capital have obviously increased now across all stages. So the markets don't reward that growth at any cost anymore. So investors will also think about, like, how much runway does this company get? Like, what do they have to achieve to unlock the next round of financing, and how much risk is there in terms of future financing? And a lower burn rate or a shorter path to break even mitigates those risks.
Ingrid, when you think about the key things that are standing out to you at the moment, is it similar to what Christoph and Danil said, or is it a little different for these later stage companies that you tend to focus on?
It's relatively similar, right? Like, again, as Danil said, the fundamentals have never really changed. They were about the same. Like, team, it's about the same, and product, regardless of where you are in the market cycle. On the point of sort of profitability and growth, yeah, I admit I care about a company's growth rate as one of the primary things first that I look at, for sure, before you dig down. But to the point, like, unit economics should always be part of what we ask at this stage. The market kind of forgot about it for a while, but that doesn't mean it didn't matter. It actually did matter, and that's sort of the mistake that many investors are ruining sometimes, that they did invest in companies in 2021. And then to the point that sort of, yes, somewhat lower growth rates have been okay at the growth stage of the past year, but not much lower, to be completely honest, because the case for how this can become a great company doesn't really change. And the second thing is that if you're growing too slowly, then there isn't a high believability that the growth rate could ramp up again. And moreover, your team isn't operating in what I would almost call like the cauldron that is actually almost the controlled chaos of when you are growing quicker than you can actually handle. And knowing and showing to an investor that that's actually something that you're capable of moving through those stages is something that we're looking for sure. So yeah, sorry, it's a bit of it's kind of the same. Maybe some things are different than margins, but not that different.
Yeah.
I would say that investors wouldn't look for founders that are like building the product, waiting too long to launch, and then, okay, this is like another version of this product and it never hit the market yet. So, like, I mean, what impressed even about our product, that we started selling from the first day one without having a product. So we got the customer loyalty. And this is what impressed investors. Like, they want you to show the results. They want you to see, they want to see your customers happy, like, as soon as possible. And this data is important for them.
Yeah. We have a question from the audience, a very specific case, not about the team or the product, but asking about metrics. So we have Ioannis, sorry if I mispronounced your name there, who's asked a question about what they should be focused on, what metrics they should be fixating on in order to show value during their pitch. Saying that their startup works on helping other companies become capital efficient through AI automation of revenue teams, and asking what are the metrics that I need to fixate on to show value during my pitch to investors.
I think
I
was going to say that. Okay, fine, go.
Okay, thanks. It depends on the specific use cases which the company is addressing here. Mm-hmm. I'm looking at the question here. Again, it says, like, help other companies become capital efficient through AI automation of revenue teams. So I don't know exactly. I don't know what the product does. I imagine it's in marketing automation or sales enablement, something like that. And so ultimately, it's about showing that your customers get more done with less. I don't know exactly what that more is. That again depends on the product. It could be like if it's a CRM and maybe the product automates some of the CRM workflows, that maybe you need fewer salespeople to handle the same amount of prospects while still maintaining the same conversion rate. If it's in marketing, maybe it could mean that you need fewer people to achieve the same outcome with regards to your marketing goals. Some could be lead, could be number of leads or pipeline, something around this. So I would say it depends on the specific product and I guess kind of like the North Star metric of the team that you're trying to sell to, and then being able to really move the needle for that team with respect to that metric.
Yeah, we really had a piece, I can't remember exactly what it is, but I'll find it and send it to you after this, Ioannis, but on defining your North Star metric and how to combine that with obviously the customer value that you're preparing. And it sounds kind of like what you're saying, Christoph, that having a really strong alignment between that North Star metric and then obviously how you collect value back from your customers and being able to draw the connections there, that's probably a really great place to start, or at least a place to fixate on. Ingrid, did you want to add to that?
I was going to be way more reductive and say that if you're at a slightly later stage, then if your net revenue retention is good, it probably means that your customers like your product and want to buy more of it. But the underlying things for how you build up to that is definitely what you should focus on at the earlier stage, because you probably haven't had the product in market long enough to have built up to that number.
Yeah. Good stuff.
I wouldn't. It's hard to add, but overall, it's important how many customers you spoke with. What are the results out of this? Is this customer perception is changing? Of course, the metrics, like the basic metrics, are important. And yes, you can see. How it converts into a sales, how long does it take for a customer to close and pay you the money, and then the questions arise. If it takes you a day, then probably you're hitting the market right, and the customers are happy. But if it takes you a few months just to convert to a simple subscription, there is a problem. If your customers pay but then they leave, there is a problem. And you got to ask this question. You got to ask your customers, like your target customers, not just any random person.
Mm-hmm, mm-hmm.
And just to add to this, I think it's a good point, Ingrid, that like from a maybe somewhat later stage investor, I mean, ultimately it will show up in the company's numbers and in their retention. But I think right now, where a lot of this is so early still with these new AI tools, I think oftentimes there won't be enough history or data. And I think sometimes the traction, if you look at just the ARR or MRR of like the SaaS company we're talking about, the AI company, can be misleading, because there's this tsunami of demand when it comes to everything that is labeled AI, and somebody who's really good at pitching will probably be able to unlock some money from an innovation department at least. But so we want to find out like does the product actually work, and how do the customers look at it, to sort of try to understand if they will likely renew when time for renewal comes. Whereas I guess as a somewhat later stage investor, you already have the data to assess.
Well, and to be fair, I'd forgotten. Apologies to the person who asked the question. I'd actually forgotten already that we were already talking about a very specific type of solution that might not have existed for a very long time in the market as well. But that's why, like, all of those things are the leading indicators. Focus on them, and it's really hard. Like, you can't give your team net retention as a North Star to follow. Hi, I want to have this at 115% next quarter, not 110%. kind of not a good guiding metric for your team. Those sort of parts about, does the product work, do the customers love it? That's something you can work on and sort of and evidence. And yes, the investors still do care about that at the end of the day.
And an incredibly strong leading indicator as well, as Christoph said, of what may come. I have to shout out, if you haven't yet, in ChartMogul, we recently released a new feature called benchmarks. And what that gives you is, if you already have some understanding of, for example, your net retention, or if you're using ChartMogul, you can very easily compare yourself to the standard across the industry. At any stage of ARR, you can sort of segment that to, if you're under $1 million, if you're over 5 million in terms of annual revenue. So if you are looking to kind of contextualize your performance, to see where you might stack up with some other folks who are going out for fundraising, that can be a really good start there. Cool. Okay, I wanted to ask a question about pitfalls. Because obviously the majority of conversations that founders have with investors probably don't lead to signed checks. And so I know that for all of you, you've probably been a part of many of those conversations. And I think a common question that we get is, what mistakes do I need to avoid? You know, what do I need to make sure I don't repeat? Ingrid, we had a really interesting conversation in the dream room about this. Do you want to speak a little bit to it?
Yeah, so I think this one was really much from the context of like, how do you prove in a bear market that your company is going to grow faster, and you can feel the signs that in your particular sector, the bear market is actually sort of starting to disappear. And so what I was reflecting on was that sometimes I see a business plan, I see it going forward, and the founders aren't evidencing this sort of why are the assumptions that something is improving in that plan, why is that believable? And sort of having that evidence already lined up of, well, my pipeline conversion rate has improved over the past 6 months, my pipeline generation rate, look at how it's improved. All those like underlying up into the right charts, if you already have those evidenced, then the plan itself becomes more believable. And whereas in 2021, you might not have been pressed on this as much, as probably because many investors, their portfolio companies, were continually beating their budgets. That's not the case in 22 and 23. So the core assumption would be, this plan is maybe not one that the company will hit. Therefore, how can I be sure that it will be one? So I think that that's sort of one of the pitfalls of not thinking one step deeper beneath the surface.
Mm-hmm. To really provide the evidence that, okay, this is where my plan comes from, and it's built upon, you know, a collection of Lego blocks that actually make sense and are solid and real.
And then to be reductive, it's about, therefore, the company will need the cash that they say they need, and not more.
Yep. Great example. Danil, Christoph, pitfalls to avoid. Anything that jumps to mind?
Right. So I think don't raise too late. This is the pitfall many founders are like, I'm not ready, we don't have traction or something. You got to build relationship now. And because of this crisis and everything, it's not taking as much time as before. Like it used to be like, I mean, I'm probably wrong with numbers, but it used to be like 3 to 6 months to raise a round in Silicon Valley. But now it might be like 6 to 9 months or maybe more. It depends on the industry. Overall, it's just longer, and you cannot like get a check right away. You gotta first build relationship with an investor, show some progress, and sometimes it's happening. Somebody's getting a check, but it's more in most cases. It's all about relationships. It's all about investor updates, and sometimes you are like starting around when you don't have any investors even like looking at, I mean, knowing about you. And some founders are doing like some tricks, which in my opinion work well for some, which like first they get a relationship with investors, get a little bit mass of the investors, and then they announce the round that, oh, we are raising now, let's do this. You want to join, and some of the investors already know them and probably will see some kind of traction of interest of investors around them. And so maybe they create some FOMO, but I mean, it's a little bit of a next level, I think.
Yeah. Christoph, what about you?
Yeah, so I mean, fundraising has become significantly harder than it used to be until about 2 years ago or so. So I think it's really important to prepare for this really well. I think some of the things maybe you were able to get away with 2 years ago might be a problem now. And in terms of just the quality of the deck and your numbers, or like things that you would put into a data room. And agree with Danil, there's a high chance that it will take longer. So you have to start early enough, keeping in mind how much runway you have, and this can lead to difficult trade-offs, right? Because obviously, if I wait 3 months, I'll be further ahead. I've hopefully cracked some milestones and shown some more momentum. But then, like on the other hand, I have 3 months less runway. So you have to somehow find the right balance there. Hopefully, you have either existing investors, or if it's the first round, maybe some other founders or people who you can ask and kind of test, get some feedback on your pitch and the fundability. So you can try to get out at the right time. And I think you also have to talk to a larger number of investors. You need to have a bigger pipeline, because you will probably get a number of no's until you start to get some yeses.
Yeah. At the end of the day, it's a numbers game, right? In terms of getting out there and speaking with people, and I guess getting feedback as well. From the discussion today, it sounds like the three of you obviously are very proactive and forthcoming with what you're looking for, what you need to see, and so a great reminder as well to get out there and chat with folks. I do have one final question, maybe the trickiest, I don't know, of the panel. Certainly the most challenging in terms of thinking about the future. So we're now sort of 2/3 of the way, or almost 2/3 of the way through Q1 2024. And at least from the data that we see at ChartMogul, looking at B2B SaaS growth rates, I think it looks like we're sort of at the bottom of the U. And certainly in some segments, especially in very sort of early stage companies, we start to see that growth start to come back and build. Slowly, but hopefully eventually all at once. I know that I may be overly optimistic. I am a marketer after all, but I'm feeling positive about 2024, certainly very positive about 2025. How are you all feeling? What's the prognosis for 2024 when you think about the investments market? And will we see a repeat of last year, or will it change once again? Ingrid, you kicked this whole session off by saying, hoping for a very predictable year.
Yes.
Is that your answer?
I think that we're seeing already more activity in the Series A and B or Series B phase than we did a year ago. What's a little hard to tell, and sort of that's what we'll see, is that obviously there's a crop of companies that have sort of grown up in the past 2 to 3 years where the founder is really like, why didn't I do this two years earlier? It would have been so much better. I would have been ever better off financially right now. But you're also seeing companies that did indeed figure out how to grow leaner, and actually sometimes figure that they have been able to do just as well. And so you're definitely seeing more companies being willing to come and test the market. And I think that but at the same time, overall, not the volumes that we had 3 years ago for sure. On the other hand, we also had companies who did go for venture fundraisings 3 years ago that perhaps are happier these days as profitable, like growing companies, and have stepped off the venture capital fundraising train. So overall, I think we are going to get back to a more normal market, but it may come at fits and starts because not all sectors are sort of returning to growth at the same rate, depending on the segment that the company is serving.
Yeah, makes sense. Danil, similar thoughts, or what are your projections?
Well, I'm not sure we hit the bottom of the crisis, but I'm feeling very positive because I think we're living in great, crazy, like amazing time. Just because what is changing, it's gonna be like a significant change for maybe the next 10 years. And the AI was a buzzword for the past 5-10 years. Now it's like acting, like, and we see the results. I'm not like real advocate of AI, but I see so much potential right now for that. And what I see from founder perspective is just really helping them to be more efficient, doing things faster, getting the answers faster. And it can help them with customers, with internal efficiency, with public searching of investors, and so much more. But what I see that founders learned to get revenues sooner. So they're not just playing the capitalization card, but also they know that sometimes it's hard to raise and they need to start making money to cover their own expenses and have some cash in their bank. So this like probably some advancements. I don't know, maybe some AI things will bring some more things, but I guess the basics are still there. Founders need to impress their investors, customers. And what I really love about all these things happening in recent years, that VC companies have building communities, and communities of customers is the loyal thing that I'm not sure AI or something else will help you. Like your relationship, your true relationship with your customers at volume, if you figure this out, may really help you, forgive you some mistakes you make and get your customers in the long run.
Yeah, absolutely. Christoph, you want to hazard a prediction?
Yeah, I think I won't even try to make a prediction with regards to like the macro climate, which of course has a big impact on especially how big companies spend their money and like will they like accelerate their IT spend. But I think for early stage startups, they are not completely removed from that. So it's not like the macro does not play a role at all, but I think like the micro factors are much more important, and from that perspective, it looks great, right? Because you have, as you said, Danil, like you can build much faster using AI, and there are many other interesting technological developments. Like think about AR and VR. So there's a lot of interesting things and reasons to be excited about technology and startups, and probably good for especially early stage founders to try to worry as little as possible about like the whole macro situation, which you can't change anyway. But I also obviously admit that nobody's living in a vacuum, so you also have to observe them and adjust if necessary.
Yeah. Space for optimism, but also at the same time, I think everyone here is watching with experience from the past few years and not putting all our eggs in one basket just yet. Thank you, to the panel for all of your answers today. This has been a really interesting discussion. I won't try and summarize it, but I think two things that have really stood out to me, or maybe three things that have stood out to me. Firstly, Danil, you mentioned, just to remember that at the end of the day, as a founder, your job is to make your customers happy and to deliver that customer value. And if you're doing that and doing that well, then, good things will come, or at least you're setting yourself in the right direction. Ingrid, you talked about proof points, and I think that's important for everyone here to keep in mind, that not just being able to say this is our growth plan and we feel confident in it, but to actually really prove that confidence, where that comes from those early leading indicators like early conversion rates, for example, at the top of the funnel perhaps. And then Christoph, I'm sorry to throw you that AI question, but it's just too easy not to mention, isn't it? We know that last year AI did get a lot of investment, but really great to hear from you that, no one here should be developing AI play for the sake of, developing an AI play or doing it for the sake of investment, but really making sure that we're connecting that in with how we're developing our products and obviously value back to the market. Probably a lot of people here, have reflected on those. I know we've had a few other questions coming through as well. The recording of this will be live, and we'll be sharing it out with everyone who registered for this event. And obviously, if you're here in the audience and you still have questions to ask, reach out to these folks on social media, on Twitter and LinkedIn. I'm sure they'll be happy to chat. Thank you, Ingrid, Christoph, Danil, so much for being here today and being part of this conversation. Super interesting. And for everyone else, we do have our next live discussion coming up in about a month's time. That's going to be on the very important question of, is CLG, or customer-led growth, the new PLG? I'm sure there's a lot of opinions. I know even in amongst this group, we've got a lot of opinions. So we're looking forward to that one in a month's time. We'll see you then. Thanks, everyone. Have a great day.
Thank you for inviting me.
Bye. Thank you.
Thank you.